Did you know that over 63% of homeowners could face unexpected costs or even lose value on their homes, all because of a silent government shift already in motion? That's right. New federal and local housing laws are being quietly rolled out, and by 2026, the way you own, live in, and even sell your home could look completely different. We're talking about forced upgrades, skyrocketing taxes, and even restrictions on how you use your own property, and most people don't even see it coming. Why isn't anyone talking about this? Because the changes are hidden in legal documents, policy briefs, and zoning codes the average person never reads. But in this video, we're breaking it all down. 10 critical reasons these changes could impact you and your home, and more importantly, how you can prepare before it's too late. Stay with us. Your biggest investment may depend on it.
Number 1. Your property taxes could skyrocket without warning. Imagine opening your next property tax bill and finding it's $3,000 higher than last year, with no warning and no major change to your home. Sounds outrageous, right? But for millions of homeowners, this could become a harsh reality by 2026. Here's why. As part of the government's push to modernize housing infrastructure and fund climate-related initiatives, many states and local governments are adjusting how they assess property taxes. Instead of using traditional home value or market trends, some areas are moving toward projected value assessments, a system that estimates what your home could be worth after mandated upgrades or market inflation. In simple terms, they're taxing you not on what you have now, but on what your home might be worth in a few years. To make things worse, many cities are reevaluating entire neighborhoods, especially in fast-growing suburbs or areas affected by rezoning plans. This means even modest homes could see massive tax hikes just because a new development opened nearby, or your area was labeled high value due to future growth potential. And for homeowners on fixed incomes or tight budgets, this could be financially devastating. While some states offer exemptions or rebates, many of these benefits are being reduced or removed under the new legislation. That leaves everyday homeowners footing the bill, often without knowing it's coming until it's too late. The key takeaway? Don't assume your current property tax rate is safe. Start monitoring local legislation, appeal your assessments if needed, and speak with a tax consultant. Because if you wait until 2026, the damage may already be done, and your home could become a financial burden instead of the asset it was meant to be.
Number 2. Mandatory energy upgrades could cost you thousands. If you think home improvement is optional, think again. By 2026, many homeowners may be legally required to upgrade their homes, not for comfort, but to meet new government-mandated energy efficiency standards. Across the U.S., cities and states are rolling out strict climate policies aimed at reducing emissions from residential buildings. That sounds good in theory until you realize who's paying for it. You, the homeowner. Older homes, especially those built before 2000, are being targeted for upgrades like solar panel installation, energy-efficient windows, insulated roofing and walls, high-efficiency HVAC systems, smart energy meters. Sounds fancy? Maybe, but also very expensive. Depending on the size and age of your home, these updates can cost anywhere from $10,000 to $50,000 or more. And in many cases, you won't be able to sell or rent your property without meeting these requirements. That makes your house harder to move and less attractive to future buyers if you haven't already made the changes. Some states are even introducing energy performance certificates that rate how efficient your home is, like a credit score for your house. Homes with low ratings may face penalties, higher insurance rates, or be labeled as high-risk properties. And while some grants and rebates exist, they rarely cover the full cost, and they're often difficult to qualify for. Bottom line, what used to be a personal choice, upgrading your home, could soon become a legal obligation.
If you're not planning ahead, you could find yourself scrambling to comply, draining your savings just to keep your home livable and legal. Stay tuned, because in the next section, we'll show how non-compliance could crush your home's value. We put hours of research into every video to bring you the truth most people miss, so if this helped you, hit that subscribe button. It's just one click, but it means everything to us. Number 3. Non-compliant homes could lose massive resale value. Let's say you plan to sell your home in the next few years. You've taken care of it, kept everything in good shape, and you're counting on a solid return. But what if you found out your home is now worth far less simply because it doesn't meet new government standards? That's the reality many homeowners will face as compliance regulations become the new normal by 2026. As we mentioned earlier, homes will soon be graded based on their energy efficiency, climate readiness, and even their data transparency. Yes, some areas will require digital reporting of your home's performance. If your property doesn't meet the criteria, it could be labeled as non-compliant, and that comes with consequences. Buyers are already getting cautious. Real estate experts report that properties with low energy scores or outdated systems are selling 10 to 20% below market average, and that gap is expected to grow. Think about it. Why would a buyer pay full price for a home they'll need to invest thousands into just to meet new legal standards? Worse yet, some lenders are starting to tighten mortgage approvals for non-compliant homes. That means fewer buyers can even finance the purchase, shrinking your market and driving prices down further. And don't forget inspections. Some states are proposing mandatory compliance checks before any sale. If your home fails, you may be forced to upgrade before you're allowed to sell. In short, what you don't fix now could cost you thousands or even tens of thousands later. Coming up next, we'll uncover how zoning law changes could affect how you live on or profit from your own land. Number 4. Zoning law changes could restrict how you use your own property. Think you have full control over your property? Think again. By 2026, zoning law changes sweeping across the country may dramatically limit what you can do with your own land, even if you've lived there for decades. Zoning laws, which dictate how land can be used, are being rewritten in many states as part of broader efforts to address housing shortages, climate goals, and urban planning agendas. While the intentions may sound positive, the reality for homeowners is far more complicated and costly. For example, in some areas, new rules are banning short-term rentals like Airbnb, limiting income opportunities for homeowners. In others, you may no longer be allowed to build an addition, garage, or granny flat without going through costly reapproval processes, even if you were originally zoned for it. Some cities are rezoning entire neighborhoods for multi-use housing or green zones, meaning your property could be reclassified and in some cases subjected to additional taxes or usage restrictions. This is especially risky for homeowners who rely on rental income or home-based businesses. Even things like fencing, landscaping, and driveway expansions are now being regulated more tightly in some jurisdictions. And once these changes are in place, fighting them is nearly impossible without legal help, which can cost thousands. Bottom line, zoning changes can silently strip away your rights as a property owner, and most people won't even realize it's happening until they're denied a permit or fined for a violation they never knew existed. Coming up next, how even your side hustle or rental unit could get you flagged and fined under new income reporting rules. Number 5. New rental income reporting rules could trigger IRS trouble. If you rent out part of your home or even just list it on Airbnb a few times a year, the IRS has its eyes on you. Under new legislation tied to the government's broader housing reform, rental income reporting rules are tightening fast, and by 2026, failing to report even small earnings could trigger serious tax consequences. Previously, if you made under a certain threshold, like $20,000 from platforms such as Airbnb or Vrbo, you didn't necessarily get a 1099-K form or have to report it in full. But now, with the lowered reporting threshold of just $600, millions of homeowners will be pulled into the IRS spotlight. That means even occasional room rentals, basement suites, or short-term vacation listings are now subject to full income reporting with detailed documentation, expense tracking, and potential audits if anything looks off. And here's the kicker. Many homeowners aren't aware of these changes and may unintentionally underreport earnings, thinking the old rules still apply. The IRS is also investing heavily in AI-powered audits, using algorithms to catch under-the-radar income. If your bank deposits, online listings, or utility bills suggest you're hosting guests, but you didn't report rental income, you could face penalties, back taxes, and interest fees. It doesn't stop there. If you're renting out space in a non-compliant home, as discussed earlier, you could also be violating zoning and energy compliance laws, creating a perfect storm of legal and financial issues. Moral of the story: if you earn any money from your property, even occasionally, it's time to get your tax game tight before the government comes knocking. Next up, the hidden insurance crisis no one's prepared for.
Number 6. Climate risk zones are creating an insurance crisis. Imagine being told your home is now considered too risky to insure. Sounds extreme, but it's already happening across the country, and it could get far worse by 2026. As part of sweeping government reforms and updated FEMA flood maps, climate risk zones are being redrawn to reflect rising threats like wildfires, floods, hurricanes, and extreme heat. While the goal is to increase preparedness, the side effect is creating an insurance crisis, especially for homeowners in high-risk areas. Insurance companies are now pulling out of entire regions, refusing to renew policies, or drastically raising premiums. In California, Florida, and parts of Texas, homeowners have seen their annual insurance costs double or even triple overnight, if they can even get coverage at all. What's worse? Without insurance, your mortgage could be at risk. Most lenders require homeowners insurance, and if you can't maintain it, you could be in default even if you've never missed a payment. And don't think this only applies to coastal or rural properties. Suburban homes near forests, rivers, or even steep hillsides are now being flagged under updated risk models, some of which were developed without homeowner input. Even newer homes aren't safe. If your area gets reclassified, your rates could spike regardless of how well your property is maintained. Some states are trying to step in with last resort insurance programs, but they're often limited, expensive, and slow to pay out in disasters. The big picture? Climate policy and insurance regulation are becoming deeply connected, and your home's insurability could now depend on government risk maps, not just your maintenance or safety measures. Coming up next, why getting a mortgage or refinancing might become harder than ever, even with good credit. Number 7. New mortgage rules could block your ability to borrow. You've paid your bills on time, kept your credit score high, and built equity in your home. So getting a mortgage or refinancing should be easy, right? Not anymore. By 2026, major changes to federal lending guidelines could make borrowing against your home much harder, even for responsible homeowners. Here's what's changing. Government-backed lenders like Fannie Mae and Freddie Mac are introducing new risk-based lending criteria tied to everything from energy compliance to climate zone classification. That means your ability to refinance, apply for a HELOC, or secure a new mortgage may depend on more than just your financial history. Homes that are located in climate risk zones, have low energy efficiency scores, or lack updated infrastructure like solar panels or insulation may be considered higher risk properties, even if they're in great condition.
This could result in higher interest rates, lower loan approval amounts, or even loan denials, especially for refinancing deals. And here's the curveball. Some lenders are already piloting these risk models, meaning the process has already begun behind the scenes, just without mass public awareness. So, what can you do? Start by checking your home's current compliance status. Get an energy audit. Review your insurance and zoning classifications, and consult a mortgage advisor before you plan to borrow. Because soon, owning a home may not be enough to qualify. Your home will have to fit the government's new risk model, too. Up next, the terrifying way homeowners could lose control over their land, even if it's been in the family for generations.
Number 8. You could lose property rights through eminent domain. What if the government decided your land was more useful for a highway, a green energy project, or a public housing development and told you they were taking it? It's not a conspiracy theory. It's called eminent domain, and it's perfectly legal. And with new infrastructure and climate initiatives accelerating before 2026, more homeowners are being targeted than ever before. Eminent domain allows government agencies to seize private property for public use as long as they offer just compensation. But here's the problem. Just doesn't always mean fair. Homeowners often receive offers well below true market value, especially if their property is labeled as outdated, non-compliant, or located in a rezoned area. And once the process starts, you can't stop it easily, unless you're willing to fight a long, expensive legal battle. In the coming years, the use of eminent domain is expected to rise dramatically, especially for high-speed rail projects, renewable energy corridors like solar or wind farms, affordable housing zones, flood and fire buffer zones. In some areas, entire neighborhoods have already been earmarked for future development, and many of the residents don't even know yet. Here's the kicker. If your home isn't up to new code or is in a risk zone, it may be appraised at a lower value, meaning you walk away with far less than your property is worth. Lesson? Don't wait until a notice shows up in your mailbox. Stay informed about local development plans, zoning proposals, and infrastructure bills. Because in this new era of aggressive redevelopment, your property rights may be far more fragile than you think. Next, how suburban homeowners are getting squeezed by urban sprawl and what it means for your future. Number 9. Suburban homeowners are getting squeezed. Think moving to the suburbs protects you from rising housing costs and government overreach? Not anymore. As big cities become more crowded and expensive, urban sprawl is pushing into suburban neighborhoods, and with it comes a wave of unintended consequences that many longtime homeowners never saw coming. Local governments, under pressure to meet housing demands and climate goals, are rezoning suburban areas for higher density housing. That means multifamily units, low-income developments, and transit hubs are being built next to single-family homes. The result? Increased traffic and noise, strained public services, and a sudden spike in property taxes due to rising land value. At the same time, suburban homeowners are being hit with higher utility fees, infrastructure costs, and compliance requirements originally designed for urban areas. You may be required to upgrade your septic system, install stormwater controls, or comply with new green space mandates, all out of pocket. But perhaps the biggest hit is emotional. Families who bought in peaceful neighborhoods are now feeling pressured to sell, unable to keep up with costs, or uncomfortable with the rapid changes around them. Some call it quiet displacement, not forced eviction, but financial nudging that slowly pushes homeowners out. And with the 2026 policy deadline looming, many of these changes will soon be locked in, making reversal nearly impossible. The bottom line? Suburban homes are no longer safe havens. They're becoming the new battleground for housing reform. And if you're not paying attention, you could find yourself caught in the middle,
with higher bills and fewer choices. Next up, the 2026 deadline and why it's the point of no return for homeowners everywhere.
Number 10. The 2026 deadline is the point of no return. All of the changes we've talked about, from rising taxes to zoning laws, energy mandates, and insurance restrictions, are not distant possibilities. They are already being passed, tested, and quietly rolled out across the country. By 2026, many of these policies will go from optional to mandatory, and for homeowners who aren't prepared, that deadline could be devastating. We're talking about penalties for non-compliance, blocked home sales due to failed energy inspections, mortgage denials, and even forced upgrades just to keep your home legally habitable. Think of 2026 as a line in the sand. After that date, you may no longer have a say in how much you pay, how you use your home, or whether you can pass it on to your kids without major costs. Here's the catch. Most of these changes are not being openly discussed on the news or social media. They're buried in policy briefings, zoning meetings, and climate legislation, quietly creeping into law while homeowners stay unaware. But the clock is ticking. Governments are giving homeowners this short window to comply voluntarily, access limited rebates, and make changes on their terms. After 2026, the flexibility and the funding may disappear. So the question is, will you be ready in time? Because what you do in the next 12 to 18 months could mean the difference between financial security and a home that becomes a legal and financial trap. Coming up next, what you can start doing today to protect your home and stay ahead of the curve before it's too late. The truth is, the game is already changing, and most homeowners are still playing by the old rules. By the time 2026 arrives, these new government policies won't be news anymore, they'll be law. And those who didn't prepare could face unexpected bills, lost property value, or even legal roadblocks that make it harder to sell, rent, or keep their home. This isn't fear, it's a wake-up call. The signs are clear, the data is public, but the choice is personal. Will you be caught off guard, or will you take action while there's still time? Because one thing is certain, doing nothing will cost you far more than taking small, smart steps today. Stay with us. The next part could save you thousands and protect your biggest investment. Here's what smart homeowners are doing right now to stay ahead of the 2026 deadline. Get a home audit. Hire a certified energy auditor or home inspector to assess where your property stands in terms of efficiency and compliance. Monitor local policies, join city planning groups, check your county's zoning board, and subscribe to local government newsletters. These changes often start quietly. Consult with a property tax consultant. Don't wait until your bill doubles. Professionals can help you appeal unfair assessments or prepare for shifts in valuation. Look into grants and rebates. Many governments are offering time-limited incentives for upgrades like solar panels, insulation, and energy-efficient systems, but they're drying up fast. Consult a real estate or mortgage advisor. Ask how upcoming policies may affect your ability to refinance, sell, or borrow in the future. Acting now gives you leverage. Waiting could cost you everything. Before you go, what's one change you think every homeowner should prepare for first? Drop it in the comments. We read every one. If you found this eye-opening, check out our previous video where we reveal 5 hidden threats to your home's value in 2025. We pour hours of research into every video to keep you ahead, so please support us with a like and hit that subscribe button. It's just one click, but it means the world to us. Stay prepared, stay smart, and we'll see you in the next one.